Hey there, and welcome back to the Deep Dive. Today, we're plunging headfirst into a financial puzzle that has certainly had the market buzzing. We're talking about the recent exclusion of strategy, the company formerly known as MicroStrategy, from, well, one of the most influential stock market indices globally, the S&P 500. Now, you might be asking yourself, why does this one company's index status matter so much? Or maybe, what even are the secret rules for getting into a club as exclusive as the S&P 500? Well, we've compiled a stack of articles, research, and expert analyses to unearth exactly that. Our mission today, to dig into why MSTR didn't make the cut, demystify the S&P 500's, let's say, famously strict requirements, and explore what this decision might signal for other innovative companies, especially those challenging traditional finance.
Indeed. And the S&P 500, it isn't just some list of companies. It's widely regarded as the best single gauge of large cap U.S. equities. It picks 500 leading companies, and together they represent, about 80% of the available U.S. market capitalization. It started back in 1957, pioneered the market cap-weighted index idea in the U.S., and today, countless investment products are based on it. For many corporations, getting in is seen as the pinnacle of corporate prestige. It brings credibility, huge investment flows. So strategy's situation, especially given its market performance, it definitely presents a fascinating dilemma, worth a closer look for sure.
Okay, let's unpack this then. Before we really zoom in on strategy-specific story, maybe we should establish the ground rules. Like, what exactly does a company need to do to even get considered for the S&P 500? Because like you said, these aren't just any businesses, are they?
That's absolutely right. No, it's not just about being big. The S&P 500 has this a remarkably rigorous set of criteria. They're meticulously designed to ensure it represents only, quote, the most stable and reputable firms. It's about more than size. It's financial health, investor access. When you look at their official methodology document, several key hurdles jump out immediately. Each serves a purpose. Okay, first off, it has to be a U.S. company. Seems basic, but it sets the scope. Then you get into the numbers. Market capitalization is a big one. A company needs an unadjusted market cap of USD 20.5 billion or greater. That's as of Feb 2025, mind you. That's the total value, public and private shares. But then crucially, it's float-adjusted market cap.
Ah, this share is actually available for trading.
Exactly. That float-adjusted value needs to be at least 50% of that minimum threshold. It ensures real liquidity, real accessibility for investors.
Got it. So it's not just about being huge overall, but how much is actually out there for, everyday folks to trade. Makes sense. It ensures the index reflects the investable market.
Precisely. And building on that, they also need a substantial public float. They measure this with something called an investable weight factor, or IWF. That needs to be at least 0.10. It just reinforces that enough shares need to be actively traded. But here's where it gets really critical for stability. Financial viability. Specifically, profitability. Companies have to show positive as-reported earnings over the most recent quarter, and also over the most recent 4 quarters summed together.
Wow, okay. So not just a one-hit wonder quarter, you need sustained profit.
Exactly. It's about a demonstrable, sustained profitability. No flash in the pan.
That profit rule sounds like a major filter. It must weed out a lot of, say, speculative ventures or even big companies that are maybe growing fast but still losing money. It really underlines that stability point.
It does. And beyond profit, adequate liquidity is paramount. The stock needs strong, consistent trading activity. There's a ratio. Annual dollar value traded to float-adjusted market cap should be at least 0.75. And maybe even more telling, the stock has to trade a minimum of 250,000 shares in each of the 6 months leading up to evaluation day.
Okay, so it needs to be actively followed, easy to buy and sell, prevents weird volatility from stocks nobody trades.
Right. And then finally, there are rules about the type of company. Mostly U.S. common equities on major U.S. exchanges, plus REITs. But things like closed-end funds, ETFs, ADRs, ADSs, those are explicitly out. And while it's not a hard number, the committee also looks at sector balance. They compare a sector's weight in the S&P 500 to its weight in the broader market, aiming for, representation.
Wow, that is an incredibly detailed and rigorous checklist. It's crystal clear they want financially sound, actively traded, established U.S. businesses. So, given these pretty demanding rules, how on earth does strategy, MSTR, fit into this picture? Because their business model, well, it's become anything but traditional strategy, trading as MSTR on NASDAQ. It's really undergone this dramatic transformation. It's quite a pivot, actually. They went from being a pretty standard enterprise analytics software company to what they now proudly call the world's first and largest Bitcoin treasury company. It's a bold claim.
Yeah.
And their strategy is remarkably straightforward, almost singular. They just strategically pile up Bitcoin. They fund these buys using proceeds from selling stock, issuing debt, and also cash flow from their software business that's still running. And they are not kidding around. They currently hold over 636,000 BTC in their treasury. That's a massive amount for a public company. They still do the AI-powered software analytics, yes, but their core identity now, and definitely their market value, it's overwhelmingly tied to Bitcoin.
And, that audacious strategy. By most metrics, it's paid off incredibly well for shareholders, at least in stock performance terms. Since August 2020, which is really when they started this big Bitcoin push, MSTR stock, it's just skyrocketed, up by a staggering 1,620%.
1,600%. Wow.
Yeah. And just for context, that absolutely blows away Bitcoin's own gain, which were impressive at 426%, and the S&P 500's 73% over that same time frame. What's really telling, though, is how the correlation shifted between MSTR stock and Bitcoin's price. Before August 2020, it was actually negative 0.658. They often moved opposite ways. After they pivoted, it flipped to a strongly positive 0.883. The market now fundamentally sees MSTR as essentially a Bitcoin proxy.
So the stock just tracks Bitcoin now, more or less.
To a large extent, yes. And because of that unique position, MSTR stock pretty consistently trades at a premium compared to what its value would be based just on the software business alone. Averaging about 15.22% over 4 years, this premium, it clearly reflects investor bets on Bitcoin's future channeled through MSTR. So you look at the checklist. They seem to meet many of the S&P 500's technical eligibility criteria. Market cap, check. Liquidity, check. Amazing returns, double check.
Which really sets the stage perfectly for the big question, right? The mystery we're trying to solve.
Yeah.
Why, despite all this, were they left out?
Right. Here's where the plot really thickens. Because despite seeming to tick so many of those technical, objective boxes we just carefully went through, strategy was very noticeably absent from the latest S&P 500 index rebalancing announcement. And that decision, while it really blindsided a lot of people in the market, it strongly suggests the committee's thinking goes beyond just the numbers on the page. It feels like there's maybe an unwritten rulebook in play here. Well, what's truly fascinating, and maybe a bit controversial, is the role of this S&P U.S. Index Committee. It's pivotal, but also quite opaque. The members, not publicly known. Their identities are purposely kept anonymous. Why? Apparently to deter financial or social lobbying.
Ah, so they can make decisions without pressure.
Theoretically. And they hold the ultimate say. Perhaps most importantly, the committee does not have to explain its denials. Their decisions are explicitly discretionary, which means even if a company perfectly matches every single published criterion, the committee can still just say no. We've seen it before, actually, with other high-profile companies facing unexpected denials or sometimes controversial inclusions. It adds this subjective layer on top of what looks like an objective process.
So wait, even with all those super detailed rules about market cap, profit, liquidity, it boils down to a few anonymous people making a judgment call they don't have to explain. That feels like a significant tension. Objective metrics versus subjective calls. It almost sounds like they're saying, okay, you hit the numbers, but we don't like your type of business. Is that too cynical?
Perhaps not entirely cynical. According to our sources, the core reason for strategy's exclusion does seem to stem from, let's call it, a deeper divide over Bitcoin-focused business models. The committee apparently considered broader sector and business model factors amid ongoing debate about Bitcoin-centric firms. It seems MSTR's asset composition, meaning all that Bitcoin and its, quote, potentially unprecedented reliance on Bitcoin for both its value and its treasury, those were factors weighing against it, and importantly, the committee has simply never granted access to a BTC treasury company before.
So it's the novelty, the lack of precedent.
Exactly. In their eyes, MSTR represents a new type of stock. Its valuation comes overwhelmingly from its BTC holdings, not from, the traditional discounted cash flow analysis of a profitable operating business. Eric Balchunas, the Bloomberg analyst, put it quite succinctly. He suggested MSTR's rejection, even with its strong fundamentals. It suggests an inclination towards more traditional corporate profiles, basically a reluctance to welcome successful companies rooted in newer, maybe disruptive technologies.
Sounds familiar. Didn't Tesla have a similar issue?
Precisely. Tesla experienced lengthy and unexplained delays before it finally got into the S&P 500, even though it seemed to meet many criteria much earlier. It really points towards a certain, let's say, conservatism that characterizes the selection committee's current posture.
So they're not just checking the balance sheet. They're scrutinizing the actual business model's DNA. And in this case, the Bitcoin-heavy DNA was maybe a bridge too far for the committee right now.
Okay, given this conservatism, What does this rejection mean for investors like you, especially those holding broad market index funds? And how did the market react initially?
Well, the immediate market reaction was pretty clear. MSTR shares dropped near 3% right after the announcement. For many watchers, this decision just seemed to reinforce those lingering concerns about its Bitcoin-driven business approach.
Yeah.
It kind of highlighted this persistent market hesitancy around these Bitcoin-centric models. It basically signaled that, look, despite MSTR's performance, traditional finance via the S&P committee is still pretty wary.
Okay, a 3% dip. But what about the bigger picture, the passive investors you mentioned? Yeah, the implications go way beyond that dip, especially for passive investors. See, getting into the S&P 500 is huge because it triggers massive passive flows. So you think about all the index funds, the ETFs, the retirement accounts that have to buy the stocks in the index they track. It's automatic, guaranteed buying pressure.
All right, billions of dollars just flow in automatically.
Exactly. It's a substantial, sustained inflow of capital that really helps support a stock's valuation. Being excluded means those flows are stifled for MSTR, which effectively limits exposure for all those traditional broad market investors. They don't get strategy, even indirectly, through their S&P 500 fund. And this really does raise critical questions for financial advisors and individual investors alike, doesn't it? Like, do current passive investment options truly reflect the market as it actually is today, especially with these innovative crypto-related assets becoming so significant?
That's a massive point. If you just own an S&P 500 index fund, you're implicitly not owning MSTR, no matter how well it does or how innovative it is. All because this anonymous committee effectively drew a line in the sand saying not yet, or maybe not you. So looking ahead then, what's the future hold for strategy and for other crypto-focused companies hoping to join these big mainstream indices? Is that line in the sand permanent?
Well, it's definitely not a static situation. There are some key developments happening that could really shift the landscape. One really big one is new guidance from FASB, that's the Financial Accounting Standards Board. This new guidance lets companies measure digital assets like Bitcoin at fair value, and crucially, record changes directly in net income.
Instead of the old way where they basically only recorded losses.
Exactly. Previously, it was often treated like an intangible asset recorded at cost, then written down if the value dropped, which could create big reported losses even if the asset value went up later. MicroStrategy itself estimates this new rule could increase retained earnings by approximately $3.1 billion, which could potentially flip its recent history of losses into a clear picture of positive earnings.
And positive earnings.
That was one of the key criteria we talked about.
Precisely. That four-quarter cumulative profit requirement. This accounting change could potentially clear that major hurdle for S&P 500 inclusion next time around.
Interesting. So the rules themselves might be changing in a way that helps them. What about sentiment? What are people saying? Well, community sentiment, say on platforms like Reddit, it's pretty divided, really mirroring the wider debate. Some folks were not surprised at all by the exclusion. They see it as, typical conservative gatekeeping. But then there's a significant group who believe inclusion is basically inevitable down the road. They draw comparisons to Coinbase or, like we mentioned, Tesla, other innovative companies that face delays before eventually getting in. You even hear some saying that ultimately the S&P needs Bitcoin strategy for its own relevance to actually reflect the modern economy.
That's a bold take. The index needs the company, not the other way around.
It is. But the whole conversation sparked by MSTR's exclusion really highlights these increasingly blurred lines between technology, finance, and digital assets. It strongly suggests there's this growing need for traditional indices to adapt to meet the evolving investment landscape. Otherwise, they risk becoming, well, less representative over time.
What a fascinating deep dive. We're really seeing how intricate this world of index inclusion is. Seems like strategy, MSTR appeared to tick so many of the S&P 500's objective boxes, huge market cap, the liquidity, those incredible returns. But ultimately, that secretive committee used its significant discretion. And that decision looks like it was driven heavily by the company's unique Bitcoin-centric business model, a model that it seems was just considered too novel, too unprecedented for the S&P 500's traditional mandate, at least for now. And yeah, our sources really only focus on the S&P 500 exclusion and the why behind it, not whether MSCR got into any other indices.
And this whole situation, it really leaves us with a huge question, doesn't it? For all of us watching the markets. As crypto adoption keeps surging, undeniably, and as these truly innovative business models like strategies emerge and start to mature, will traditional financial benchmarks, the big ones like the S&P 500, will they evolve? Will they find ways to embrace these new frontiers and properly represent the modern economy? Or will their adherence to historical norms, to established practices, mean that a significant and arguably increasingly relevant part of the market just remains unrepresented within these foundational indices? What really stands out to you as you watch this tension play out, this push and pull between traditional finance and these emerging digital assets, it's definitely something to keep thinking about.